Welcome to this deep dive into what really drives trading success. If you're like most traders, you've probably spent hours tinkering with technical indicators, hoping to find the magic formula that guarantees profits. But the truth is, real trading mastery comes from understanding price action, not just following signals from indicators. So, why do so many new traders make the mistake of relying solely on indicators? It's simple: indicators are easy to use, but they don't teach you how the market actually moves. Price action is the language of the market. It tells you where buyers and sellers are active, where momentum is building, and where reversals might happen. If you want to succeed, you need to learn to read the story the price is telling you, not just react to what an indicator says. Think about this: have you ever entered a trade because an indicator flashed a buy or sell signal, only to watch the market move against you? That happens because indicators lag behind price. They're based on past data, while price action is happening in real time. When you focus on price action, you see the market as it is, not as it was. This shift in mindset can make all the difference between consistent profits and constant frustration. Now, let's talk about something that doesn't get enough attention: position sizing. Have you ever felt anxious after placing a trade, constantly checking your screen and worrying about every tick? That's usually a sign that your position size is too large. Effective position sizing is the foundation of peace of mind in trading. When your risk per trade is small, you can think clearly and stick to your plan, even when the market gets volatile. Stress is the enemy of good decision-making. By controlling your position size, you control your emotions, and that leads to better results over time. But how do you decide how much to risk on each trade? One powerful method is the Kelly Criterion. This is a formula that helps you determine the optimal amount to risk, based on your win rate and the size of your average win compared to your average loss. The Kelly Criterion isn't just for gamblers; it's used by some of the world's best traders and investors to ensure they grow their account steadily without risking too much on any single trade. If you want to build wealth over the long term, understanding and applying the Kelly Criterion can give you a serious edge. Let's move on to another key concept: analyzing multiple time frames. Do you only look at one chart when you trade? If so, you might be missing the bigger picture. By examining different time frames, you get a more complete view of the market. For example, the daily chart might show an uptrend, while the hourly chart reveals a short-term pullback. This information helps you make better decisions and avoid getting shaken out by market noise. Multi-timeframe analysis reduces emotional reactions and gives you the context you need to trade with confidence. Now, here's a question for you: how often do you place trades just because you're bored or want some action? Impulsive trading is one of the biggest killers of trading accounts. The solution is to have a structured trading plan. This means knowing exactly when you'll enter and exit a trade, where your stop loss will be, and how much you're willing to risk. A good trading plan is like a roadmap: it keeps you on track, even when the market tries to distract you. Research your setups thoroughly, stick to your plan, and avoid the temptation to trade out of boredom. Concentration is another secret weapon of successful traders. It might surprise you, but spending less time in front of your screen can actually make you a better trader. Why? Because too much screen time leads to fatigue and burnout, which cloud your judgment and make you more likely to make mistakes. Set specific times for analysis and trading, then step away and recharge. Quality beats quantity every time. Protect your focus and your mental energy, and you'll see better results. Here's something else to consider: don't quit your day job just yet. Trading is a skill that takes years to master, and having a steady income from a full-time job gives you the financial stability you need to learn and grow without the pressure to make money right away. Multiple income streams are a safety net that allows you to take the time you need to develop your trading edge. Rushing to trade full-time can lead to unnecessary stress and costly mistakes. Be patient, keep learning, and let your trading profits grow gradually. It's also important to remember that there's no one-size-fits-all strategy in trading. What worked in the past might not work today, and what works in one market may fail in another. Markets evolve, and so should your strategies. Don't cling to old methods just because they worked before. Stay flexible, keep testing new ideas, and be willing to adapt to changing conditions. This adaptability is what separates the best traders from the rest. Speaking of testing, let's talk about backtesting. Before you risk real money on a new strategy, you should always test it on historical data. Backtesting shows you how your approach would have performed in the past, giving you valuable insights into its strengths and weaknesses. But remember, past performance doesn't guarantee future results. Use backtesting as a tool to refine your strategies, not as a promise of easy profits. The goal is to understand how your system behaves in different market conditions so you can trade with confidence. So, what does all this mean for you as a trader? It means that trading success is built on a foundation of understanding price action, managing risk with smart position sizing, analyzing multiple time frames, and sticking to a well-researched plan. It means avoiding impulsive trades, protecting your concentration, and maintaining financial stability with multiple income streams. It means being adaptable, test,